Now, there's some other overriding factors that are affecting the overall growth rate of the economy. Some of them are positive, some of them are negative. So, for example, on the one hand, we've got the Fed, which has been engaged in quantitative easing to try to push markets forward to make money more available, but they're in the process of what they call tapering. They had been buying $85 billion in mortgage bonds and other types of securities, and now they've tapered back to $45 billion a month, and they're going to basically, before the end of this year, get back to zero. So that quantitative easing is slow. I wouldn't say slowing the economy, but it's not pushing it forward quite as much as it had been for the previous year when they were buying $85 billion a month in mortgage-backed securities. Now, the second thing that's going on is with consumers. And consumers, they've come back a long way from the depths of the recession, but they're not all the way back, and they've almost sort of stagnated. So if you look at the Consumer Confidence Index and you look at 90 as being normal, okay, at points in this recession, we were down in the 20s and 30s. For the last year, we've been kind of bouncing around in the low 80s. Right now, we're just a little over 80. But it's been fairly stable for the last 15 months. And so it seems as if over the course of this recovery, consumers have come back, but they haven't come back all the way to normal yet. They're still a little bit hesitant. And with 70% of the economy, GDP, being made up of consumer purchases of goods and services, you can see why that's really important. And right now, they're still a little hesitant. They're still back in the new normal phase. And that coupled with the fact that for the last 6 years during this recession recovery, consumers have been deleveraging themselves, reducing their debt, other than mortgage debt. They're reducing their debt. They've now gotten down to basically a 35-year low in terms of the percentage of their monthly income that's subject to consumer credit payments, and it's down below 10%. And there seems to be no indication that they're going to turn that around. So you put those two things together, kind of hesitant consumers, along with the reduction, if you will, in their willingness to go into debt, and that really puts a clamp, a top-end limit, if you will, on consumption, which is the biggest part of GDP. So that's kind of holding the economy back. The only bright spot that's come along in the last 6 months to kind of counterbalance that has been what's been going on in the housing market. And as we've seen the market work through its foreclosures, and then in addition to that, we've seen in the last 6 months actually housing prices start to rise nationally and in North Carolina as well. What we see is a shift, if you will, in consumer attitudes towards purchasing houses. Had been a period of time when housing prices were dropping. Consumers were sitting on their hands saying, well, if I wait, I can buy it cheaper. Now with prices rising in double digits over the last year, say 12% nationally, it's almost 8% in Charlotte. What we see is that consumers are starting to change their behavior, and they're starting to realize that if they don't buy it now, they're going to pay more for it in the future. That's the only countervailing force to a lot of these other things that are sort of slight negatives in terms of the economy. So overall, it's going to be hard for us to do much better for the next several years than, say, 2.5% rate of growth. That having been said, that still seems to be sufficient to drive the unemployment numbers down. So by the end of 2014, we should be about 5.8% in the state and pushing 5% by the end of 2015.